Good afternoon. This is Chris Robinson, Robinson Ag Marketing with today's post-close grading livestock comments for Friday, January 2nd, 2026, first day of business in the markets. Kind of an unauspicious beginning in the grains, but a really good recovery, and that's what to lead off with protein complex. We now know the funds are long, the entire protein complex, not massively long, but they've got nice long bets. For the week, fat cattle, April, finished up 635. We hit a 10-week high. For the week, March feeder cattle up 12 and a half cents at a 10-week high. Hogs finished the week down 30 cents, but it did hit a 10-week high. So the weakest performer were the hogs. Still relatively great way to start off 2026. Feeder cattle, if you look at the rally that we've had there since the November low, got to remember feeder cattle traded 293.30. Today, 353, a $60 rally, right? This is a perfect example of why it's good to use puts if you're hedging your cattle. You're long cattle already. If you sold futures, wherever you sold them down there on that break, you've been making margin calls all the way up, and you've left all that rally on the table. If you've got puts on, okay, maybe you spent 5 cents for puts. Maybe we've spent another 5 cents rolling them up. You've picked up 60 cents, okay, minus whatever you paid for the puts. So that is why put strategy in markets like this is your best friend. Now, if you tell me you don't care about corrections, if you don't care me, you don't care about potentially rolling over and losing a big chunk, that's okay. Then don't hedge. All right, we're going to move over to the grains for the day. March corn down 2 3/4 cent, 437 and a half. We did hit our 2-week low here at 437. We've been struggling ever since we fell below the 200-day moving average at 446. If you got my letter, you know I was screaming and yelling about that level being a key pivot area. It's proving out to be that right now. If you look at March soybeans, down 1 3/4 cent on the day, 10.45 3/4. However, we did fall down to 10.38. 10.38 was the um, lowest price we've had in 3 months for March beans. So just to give you a refresher course, we had gone from basically this level in October. October, we saw a low in March at 10.28. We rallied all the way up to an 18-month high at 11.72. So 11.72 down to 10.38, right? And then we bounced here. We did settle at 10.45 3/4. However, for the week, right? March beans down 26 3/4 cents. March corn for the week down 12 and a half cents. And if you look at March Chicago wheat, if you've got all that stuff stored, down 12 and a half cents on the week. We did make a new contract low today at 501 and a half. The number to be worried about next in March wheat is 492 and a quarter. That was the October low. That's a 5-year low. So we do know that the funds are long the protein complex. They're long about 100,000 contracts of soybeans. They're basically flat corn, and they are short about 100,000 wheat. So that's kind of the lay of the land. They're also short meal, bean oil, canola across the board there. But as we head into the USDA report on the 12th, that's only a few business days away. We have all of next week, so you have 5 business days, and then the following Monday is the report day. So if you don't care about potentially lower prices, then absolutely positively don't worry about it. If you're an end user and you want to take advantage of the fact that beans just hit a 3-month low, calls are on sale. That's really what it comes down to. I'm not really concerned about people's opinions at this point. We know there's going to be a big crop in South America. We don't have a weather issue down there. China's dragging its heels on coming across and buying the last 2 million metric tons from us. Although I thought they would be stepping in here and buying on this dip. I would be surprised if they didn't buy a little bit. We'll see next week if we get more confirmation of any sales to unknown. But certainly, if you knew that you had to buy beans from somebody and we hit 3-month lows, I think that would be a time for you to possibly open up your checkbook. Also, we did fall below the psychologically important 1050 level on spot beans. Again, the low of the move was 1038. You got to remember this whole mess started back on October 1st when we were at 1028 and a half. So we got to within a dime of that today. with today's low at 1038. So just all the more reason why, if you don't have some sort of a plan to take advantage of when we rally $1.50, if your plan is just to wait and see, um, it might be time to maybe address a different way of looking at your risk management. That's all I'm saying. If you want to take a look at my program, 312-638-8868, Robinson Ag Marketing. I did not reinvent the wheel. I am not perfect, but I can help you make the hard decisions, which is when to make cash sales and when to hedge, what to hedge. There are opportunities out there. There are going to be more opportunities as we move forward. My feeling about going into this report when we're at 3-month lows in soybeans, now's not the time to have aggressively expensive puts on in anything in these grains. You don't want to have a lot of money tied up in puts. Doesn't mean you don't want to have a floor because, can you guarantee me that we're not going to go lower between now and July? Are we going to do a repeat of what we've done in the last 2 years where we have a little bit of a rally January, February, and then slide lower? So much depends on how much grain comes out of South America. And right now, they're looking at huge crops down there. So you're in a situation where, yeah, it will be nice to see China and the United States make nice again. But the biggest problem facing prices is the supply. And the supply looks like it's going to grow. And when the supply grows, the amount of stuff available grows, and that puts pressure on prices. So it's going to make for an interesting and difficult 2026 marketing year. So we will get opportunities, and I just think you got to keep your powder dry. Looking in the outside markets, another kind of wild, typical. What do we have? We had almost a $4 range in silver. Crude oil still under $58. You've got diesel. So what's the silver lining in this? Diesel fuel traded down to a new 7-month low today, 209. It wasn't that long ago, guys, when we were 270, literally about 2 months ago. So that's the silver lining to anybody that needs to buy diesel. We're down here at these 7-month lows. Are we going to dip below $2? We'll have to wait and see. But that is the silver lining to these markets moving lower. The number one thing you've got to look at is, where are we going to be inflation wise heading in 2026? Are we going to get some sort of weather issue? If we do, the last thing you want is to be gummed up with having gotten too bearish down here in the hole. So keep your protection very, very, very cheap. Now you don't have to go out and buy 300 days of protection like you used to have to do. You can get your protection just to cover through this report. So that's something I think a lot of guys are maybe unfamiliar with these shorter dated options. And you can actually protect new crop with new crop options. You don't have to hedge your corn with March or April or July if you don't want to go out that far. If you're growing new crop corn for next year, get yourself a new crop corn put, which is priced off the new crop price, right? New crop corn sitting here at 460, still hanging in there pretty good. You don't want to be in a situation where we're sub 440 and, you're doing the woulda, coulda, shoulda game. Hopefully we get a rally to reward. But again, a good hedge is about spending the least amount of money as possible, not gumming yourself up with, selling 3 calls to pay for a put or something like that. It looks like a free trade until we get a problem in the market and we're exploding higher. And then you've created a problem for yourself. Same thing with doing these accumulators where, somebody says, hey, if we get to X price, double up. It looks really good when we're on our heels, but it doesn't look so good if we've got a weather issue. And unless you can promise me that we're not going to have some sort of weather issue in the next 6 months, now's not the time to be getting aggressively bearish. Doesn't mean you don't have a floor. Doesn't mean you don't put some sort of protection on, at least for the report. And anyhow, for that, I'm going to wrap it up here on this Friday. Happy New Year. Again, if you're looking for help, go to my website, robinsonagmarketing.com. If you want to get some of my letters, call me, email me, text me. I'll send you the letter for a week or two. If you like the letter, you sign up for it. It's not tremendously expensive. You can buy it month to month, or you can buy the whole year. What do I share in that letter? I give everybody specific hedges. I give everybody specific cash sale targets, okay, based on what the board price is. That's a big part of what a marketing plan can do for you. It can tap you on the shoulder and say, hey, I know you want to hold on to beans here because it just rallied $1.50, but in my opinion, you should make some sales. Just having someone make that suggestion to you sometimes can take the pressure off. And again, it's always nice to have somebody blame if it's a bad cash sale, right? You can always say, "Oh, that guy's don't want to work with him again." My background, I've been doing this for 3 decades now. I've been working with farmers for the past 15 years. Prior to that, I spent the better part of 20 years on the floor of the Board of Trade. I traded my own account. I did not have clients or customers. I did not get into this end of the business until 2010. So, on that note, that's the experience I bring to it. If you're looking for help, give me a call 312 638 8868. Have a great and safe weekend. This is Chris.